The last time you opened a new trading account, you felt that quiet rush, a clean slate and fresh capital, everything ahead of you, and somewhere in the back of your mind, a thought, this time will be different. It won't be. Not because you lack talent or trading discipline, but because the first year of trading is designed to take your money before you've built the skill to keep it. Every door you open in year one, a new indicator or a shorter time frame is a silent countdown running against your account. And here is what that actually costs you. After year one, you won't just have less money. You will trust your own trading judgment less than the day that you started, because 12 months of unstructured trading decisions will have quietly convinced you that you are not built for this. I spent 11 plus years finding out which doors to lock. And by the end of this video, you'll have the 5 decision filter that skips year one entirely. The traders who lose the most money in their first year are not the ones who study the least. They are often the ones who study the most. More videos, more indicators, more hours at the screen, and they still bleed money faster than the trader who learned one thing and stopped looking. In August 2013, a friend introduced me to forex trading while I was working a customer service officer job at a bank. I deposited $100 and I was already calculating what $1,000 could become. I'd searched online for strategies and picked up a few indicators I didn't understand. And I started buying into anything that moved quickly on the chart. Every morning before my shift, I'd open the app, scan for something, anything that looked like it was about to run. I didn't have a criteria. I had just urgency. And when a pair moved fast in either direction, I'd enter because sitting out felt like missing money. Then I'd check in at my desk during lunch, telling myself I was managing the trade, when really I was just watching it bleed and hoping it would turn around. My first month, I lost 55% of my account. I deposited another $100, and by the end of the third month, I'd lost 92% of everything. $20 left from $200. And the worst part wasn't the money. The worst part was what I was learning while I lost it. Every rushed trade was teaching my hands a habit, and every time I checked my phone looking for the next opportunity, my brain was wiring itself to link trading with urgency. The losses show up on your statement, but the trading habits hide in your reflexes, and they compound silently in the background of every trade you take. That's the year one tax, and it's not the capital you lose. It's the cost of every wrong trading habit your first year installs, because you will spend the next 3 years paying to uninstall them. Most content for beginner traders treats year one as unavoidable. Learn from your mistakes, pay your tuition, and expect to lose. And the people selling you the next indicator, the next course, the next shortcut, they profit every time you accept that framing. I don't believe year one is mandatory. I believe it is a tax. I believe it's a tax you pay for leaving 5 doors unlocked on day one. Now, here's what that looks like in practice. You're sitting at your desk after work and the charts are open. 3 time frames of the same pair, each telling a different story. You've got a setup that looks decent, but you are not sure which time frame to trust, and you're not sure how much to risk. So you keep switching tabs and wondering if that video you watched last night had a better approach than the one you tried this morning. Then you enter anyway, because doing nothing feels worse than doing something. Just this once, you are telling yourself, I'll figure out the rules later. I just need to see if it works. And then the quiet part. If it wins, that proves the strategy is fine. 3 hours later, you are checking your phone in bed. The trades moved against you and you don't know whether to close it or hold it. You don't have a rule for this because you never locked that door. Here's what I'd lock on day one if I started again today. Choose your time frame and marry it. Not because one time frame is better than another, but because switching time frames is how you teach yourself to second guess every trading decision that you make. So one time frame means one view of the market and one set of signals to learn. Decide tonight and don't revisit it for 6 months. Set your risk ceiling at 1% per trade and treat it as a physical wall, not a guideline. At 1% risk, 20 consecutive trades costs you about 18% of your account, and you can survive that. At 3%, those same 20 losses cost you about 46%, and that account doesn't survive to month 4. This isn't a risk management tip. It's the difference between having a trading account to learn with and not having one. The locks fail when you leave one unlocked and compensate with effort on the others. It's all 5 or none. You're back at the desk, same evening, same setup, but this time your time frame is chosen and your risk is fixed at 1%. And the setup doesn't meet the criteria you wrote down this morning. So your hand moves towards closing the platform. Not tonight. You close the laptop, no second chart to check, no risk to calculate. The decision was already made before you sat down. The trading education industry profits from keeping your year 1 chaotic because simplicity does not sell courses. Now you've got 2 locks in place, but knowing what to restrict does not explain why restrictions works so well in the first place. Because everything in trading culture tells you that more options means more opportunity. There is a profession where beginners handle life or death decisions within the first year of training, and their fatality rate is among the lowest in all of transport. Not because they train harder, but because they are not allowed to choose. When a new airline pilot finishes ground school and enters their first year of line training, they don't get to pick their aircraft. They don't get to pick their aircraft type, their route, or their altitude. Those decisions are locked. One aircraft, predetermined routes, and a training captain sits beside them, making every critical call until the hours catch up. The principle underneath this system isn't that new pilots are incompetent. It's that competence and decision-making develop at different speeds. A first-year pilot might have the knowledge to handle a complex approach into a mountain airport, but the judgment to know when not to attempt it takes thousands of hours to build. So the system removes the decision entirely until the judgment catches up. Every time you sit down to trade with 5 possible strategies and 15 possible markets open, you are the first-year pilot choosing their own approach path into terrain they have never seen. Choose one testing method and prove your trading edge before trading live through backtesting. Not paper trading while watching your live account bleed, and not trying it out for a few weeks. No, sit down with historical charts and test your one strategy across a minimum of 30 trades. You've probably never heard of a trading educator telling you to stop trading and go count old charts instead. And that's because testing does not look like progress, but it's the only thing that turns a guess into a trading edge. The pilot does not log flight hours during their simulator sessions, and no one questions whether the simulator was worth it. Next, pick one mentor and ignore every other voice for 12 months. Not because one voice is always right, but because 5 voices pulling in different directions guarantees you will never build conviction in any single trading approach. When I stopped listening to multiple sources in 2014 and focused on one mentor, I didn't trade live for over a year. Demo only $2 per trade when I finally went live. That shift wasn't a better strategy, it was a quieter room. I don't follow multiple trading educators. I don't watch conflicting YouTube strategies. Every additional voice in your first year is not education. It is noise. It's noise that sounds like education, and that's probably the most expensive form of procrastination there is, because it feels like progress. And if you are the kind of trader who actually applies what you learn, you could sit down tonight and lock all the 4: time frame, risk ceiling, testing method. And so you sit down tomorrow evening, one time frame, risk at 1%, one mentor, you start backtesting, and within 10 minutes, something pulls. A different time frame looks cleaner. Your results are thin, and something inside says, switch. One of these 4 locks is already rattling, and it's the one your trading history wired you to keep opening. The lock that feels most uncomfortable is protecting you from your biggest trading leak. That's why the free 3-minute diagnostic quiz in the description below identifies which lock your specific history has compromised, so that you don't waste months reinforcing the wrong one. What you are about to hear next is the 5th lock, and it's the one most traders never consider because it has nothing to do with charts. Everything you've been told about becoming a better trader involves spending more time at the screen. More chart hours, more analysis, more review sessions than you can count. But traders with the longest track records almost always trade less than the ones who are still trying to become consistent. That contradiction should bother you. 𝒊𝒔𝒂𝒎𝒑 built one of the most successful track records in trading history, and his approach was almost entirely systemized. He would check his models, identify signals, place his trades, and walk away. No sitting in front of charts all day and no second-guessing entries after they were placed. The behavioral detail that matters is not his returns. It's what he removed from his trading environment. 𝒂𝒂𝒎𝒑 designed his setup so that the most common trading mistakes, overtrading, revenge trading, moving stops, adding to losers, were structurally impossible. Not difficult, impossible. The environment did not allow them. The environment you trade in determines the trading habits that you will build. And the habits you build in year 1 determine whether year 2 is a recovery project or a growth project. 𝒂𝒂𝒎𝒑 removed the decisions that would cost him money. Your trading environment is probably still full of them. Design your trading environment before you place your first trade. Start by deleting all mobile trading apps from your phone. Not because you lack trading discipline, but because the app is designed to make you check prices. And checking prices outside your trading window trains the exact habit that produces overtrading. Set one fixed time each day to review your charts and place your orders. Then close the platform and don't reopen it until the next day. When I reduced my chart checks from 3 times per day to once in June 2019, my results improved, not because the market changed, but because I stopped interfering with trades that were already working. Once a trade is placed, don't touch it. Set your stop loss and your take profit before you enter. Then walk away. No adjustments, no exceptions. Mobile trading apps are not tools. They are engagement products designed to keep you watching. And every minute of unplanned screen time in your first year builds the trading habits you will pay to break later. Tonight, after this video, open your trading platform on your laptop, not your phone. Set one time tomorrow morning when you will check your charts and write it on a piece of paper next to your screen. And make one rule. If the setup does not meet your criteria, you close the laptop and walk away. That's day 1 of the 90-day runway. Each day you follow all 5 locks, mark it on a calendar, and each day you break one, start the count again from day 1. That's the trader who doesn't pay the year 1 tax, not the one with the best strategy or the fastest internet, but the one who locked 5 doors before they placed a trade, and then sat in the quiet of a morning with nothing to fix because the decisions were already made. Lock 3 tells you to backtest before going live. Try it right now, mentally. Pick your strategy, open a chart from last month in your mind, and count the signals. You just hit the wall. Which trades count? How do you stop yourself from seeing what you want to see? Without a specific testing structure, backtesting gives you confidence in a trading strategy that does not actually work. That's what I break down in this video. The process that turns backtesting from busy work into actual proof. The locks will hold only on honest numbers. So see you in this video.